They told you that buying a home is the smartest financial move you will ever make. They called it an investment, a pillar of stability, and the ultimate ticket to the middle class. But what if I told you that for most people, this dream is actually a carefully disguised trap designed to drain your wealth for decades? Behind the white picket fences and the pride of ownership lies a hidden math that the banks do not want you to calculate. While you are busy building equity, you are likely losing more money to invisible costs than you will ever make back in appreciation. Today, we are exposing why your biggest asset is actually your greatest liability and how it might be keeping you poor. To understand how we fell for this trap, we have to look back at how the narrative was created in the first place. For generations, the idea of owning land was synonymous with freedom and security. This cultural obsession did not happen by accident, it was a calculated shift in how society views wealth. Following the Second World War, the government needed a way to stabilize the economy and keep the workforce anchored. They turned the home into the ultimate symbol of the American dream to encourage long-term spending. This era birthed a new reality where massive debt was rebranded as a milestone of personal success. Massive subsidies and tax breaks were introduced to make borrowing money for a house feel like a gift. People were led to believe that renting was simply throwing money away every single month. This simple logic ignored the massive overhead costs that come with maintaining a physical structure over several decades. Slowly, the home became more than just a place to live, it became a mandatory social status symbol. If you did not own your roof, you were seen as financially unstable or behind in life. This psychological pressure forced millions of people to commit to 30-year contracts without ever questioning the underlying math. The introduction of the long-term fixed-rate mortgage changed the financial landscape forever. It allowed the average worker to buy something they could not actually afford by spreading the cost over their entire working career. While it felt like a shortcut to wealth, it was actually a commitment to pay the bank nearly double the home's value in interest. Most people define an asset as something they own, but true financial logic defines it as something that puts money in your pocket. A primary residence does the exact opposite by taking money out of your pocket every single month. Between taxes, insurance, and constant repairs, the house is a machine that drains your liquid cash flow. Banks and real estate agents have spent billions of dollars reinforcing the idea that your home is your best investment. They benefit from the transaction fees and the decades of interest payments you provide to their bottom line. Their marketing machines have successfully convinced the public to ignore the massive opportunity cost of that tied-up capital. We have been conditioned to look at the rising price of our homes and mistake it for pure profit. We celebrate when the market value goes up, yet we often forget to subtract the decades of maintenance and the hidden bite of inflation. This illusion of wealth is what keeps the cycle moving while your real net worth remains stagnant. This cultural obsession did not happen by accident, it was a calculated shift in the post-war era. Governments and corporations realized that a workforce tied to a 30-year mortgage is a stable and predictable workforce. By anchoring families to a single location, they ensured a steady stream of labor and consumption for the expanding economy. The 30-year fixed-rate mortgage was marketed as a revolutionary tool for building equity and security. In reality, it was designed to front-load interest payments so the bank gets paid its profit long before you own a significant piece of the property. During those first several years, your monthly payments are barely touching the actual principal of the loan. This leads to what economists call dead money, which is capital locked away where it cannot work for you. While your massive down payment sits inside your walls, it is earning 0% in dividends or business growth. You are essentially paying the bank for the privilege of keeping your own wealth trapped in a pile of bricks and mortar. Beyond the interest, you are hit with a relentless cycle of property taxes and insurance premiums that never disappear. These are not investments, they are pure expenses that often rise every single year regardless of the home's actual market performance. Over 3 decades, these recurring costs can easily exceed the original purchase price of the house itself. We also tend to ignore the fact that a house is a depreciating physical structure disguised as an appreciating asset. Roofs leak, HVAC systems fail, and interior styles become outdated, requiring constant infusions of fresh cash just to maintain the status quo. You are forced to spend money continuously just to prevent your investment from losing its appeal to the next buyer. This financial anchor ultimately limits your mobility and your ability to take calculated risks in your career. When you are tied to a massive monthly obligation, you are far less likely to move for a better opportunity or invest in a new venture. The perceived safety of the home becomes a cage that prevents you from pursuing true, liquid wealth. But the real danger isn't just the lack of mobility, it's the moment the economic winds shift and the math stops making sense entirely. We are currently witnessing a historic decoupling where home prices have soared far beyond what local wages can actually support. This imbalance is the first crack in the foundation of the homeownership dream. When interest rates were at historic lows, the trap was easy to ignore because the cost of borrowing felt like free money. However, as the global economy faces structural shifts, those cheap loans are disappearing and leaving a generation of buyers stranded. Suddenly, the math that worked for your parents has become a recipe for financial disaster. The true crisis begins when you realize the opportunity cost of that massive down payment you worked years to save. If that same capital had been placed into a diversified portfolio of productive businesses, it could have been compounding and generating cash flow. Instead, it is locked in a static asset that requires you to pay for its existence every single day. The breaking point often comes in the form of a major, unexpected repair that traditional financial advice never accounts for. A cracked foundation or a failing roof can instantly wipe out years of perceived equity gains in a single afternoon. These are not just inconveniences, they are direct hits to your net worth that you can never recover. We have been sold the lie that real estate only goes up, but history tells a much more volatile and dangerous story. When a local market cools or an industry leaves town, your supposed safe haven can quickly become an underwater nightmare. You are left holding a physical liability that you cannot sell without taking a life-altering loss. In a financial emergency, you cannot eat your kitchen cabinets or pay for a medical bill with your backyard. Real estate is one of the most illiquid assets on the planet, meaning your wealth is effectively held hostage by the market. This lack of access to your own money is the ultimate vulnerability during times of economic uncertainty. Even when the price of your home goes up, inflation is silently eating away at the purchasing power of those future gains. When you adjust for the rising cost of living and the thousands spent on interest, most homeowners are barely breaking even. The profit people brag about at dinner parties is often a mathematical illusion once the real numbers are tallied. We are now entering a new era where the old rules of wealth building are being completely rewritten before our eyes. The traditional path of buying a home and waiting 30 years is no longer a guaranteed strategy for success. To survive this shift, you must stop thinking like a consumer and start looking at the cold, hard data of your own balance sheet. The moment you look at those numbers, the reality of opportunity cost hits you like a freight train. Every dollar locked inside your walls is a dollar that is not compounding in the stock market or funding a high-growth business. This realization is the first step in breaking the cycle of generational wealth stagnation. We are witnessing a historic decoupling where housing prices have outpaced median wages by a staggering margin. This gap has turned the dream of homeownership into a high-stakes gamble that many simply cannot afford to lose. The safety net that once protected the middle class has been replaced by a tightrope over a financial abyss. Once you sign that mortgage contract, you are effectively betting that the next 30 years will be as stable as the last. However, the global economy is becoming more volatile, and being tied to a fixed location is now a strategic disadvantage. The flexibility to move where the capital flows is the new currency of the modern age. This is where the trap finally snaps shut on the unsuspecting homeowner. You realize that while you were busy paying for a roof, the truly wealthy were using their liquidity to acquire assets that actually generate cash flow. You have traded your freedom for a pile of bricks, and the math shows that the trade was never in your favor. Most people respond to this realization by trying to optimize their mortgage or making extra payments to own the asset faster. They believe that by shortening the term, they are finally winning the game against the bank. However, this strategy only locks even more of your liquid capital into an illiquid box. We are often told that a mortgage acts as a forced savings account for those who lack financial discipline. This assumes that the only way to build wealth is to be coerced into a monthly bill by a lending institution. In reality, you are just substituting a productive habit with a high-interest obligation that carries massive penalties for failure. The first real obstacle hits when you encounter the true cost of the maintenance rule. Financial experts suggest setting aside 1% of the home's value every year for repairs, but this is often a gross underestimate in a volatile economy. A single major system failure can instantly devour your entire annual savings and force you back into high-interest consumer debt. You might try to access the equity you have built through a home equity line of credit to fund other investments. This is where many homeowners discover the hidden fees and the predatory nature of borrowing against your own shelter. You end up paying interest to the bank just to use the money you already worked hard to save inside your walls. Even if you manage to keep the house in perfect condition, you face the uncontrollable barrier of rising property taxes. Local governments frequently reassess property values, meaning your investment success results in a higher annual penalty for the crime of owning a home. You have no control over these costs, yet they can fundamentally alter your monthly cash flow overnight. Many attempt to solve the stagnating wealth problem by trading up to a more expensive property in a better neighborhood. They view this as a way to increase their exposure to real estate gains, but they are actually just increasing their overhead. This cycle of lifestyle inflation ensures that every raise you earn at work is immediately swallowed by a larger mortgage and higher utility bills. When you finally sit down to run the numbers against a simple index fund, the discovery is often devastating. You realize that the same monthly payment invested in the stock market would have likely outperformed your home's appreciation by a significant margin. The math reveals that your safe path was actually a detour away from true financial independence. Breaking through this first barrier requires you to ignore the well-meaning but flawed advice of friends and family. Most people are so emotionally invested in the idea of homeownership that they cannot look at the data objectively. You are not just fighting a financial system, you are fighting a deeply ingrained cultural myth that equates a deed with dignity. This pressure becomes even more intense when you try to present these findings to a real estate agent or a mortgage broker. They will immediately pivot to emotional manipulation, telling you that you are building a legacy or that renting is simply helping someone else get rich. This social friction creates a psychological barrier that makes you feel like a financial outcast for simply following the logic of the numbers. A common counterargument you will hear is that a mortgage serves as a forced savings account for the undisciplined. This hypothesis fails to account for the fact that these savings are being eroded by unrecoverable costs every single day. You are essentially paying a massive premium for a savings vehicle that charges you for the privilege of holding your money. As you dig deeper, you begin to uncover the hidden layer of phantom expenses that never appear on a listing page. Homeowners association fees, special assessments, and the inevitable lifestyle creep of furnishing a larger space quietly drain your monthly surplus. These initial discoveries often reveal that the true cost of ownership is nearly 40% higher than the initial mortgage payment suggests. This leads to the realization that your supposed asset has actually become a pair of golden handcuffs. You find yourself unable to take a lower-paying dream job or move to a more vibrant city because your monthly obligation is too high. The very thing that was supposed to provide you with security has instead stripped away your most valuable asset, your freedom to choose. This loss of freedom is the direct result of a fundamental misunderstanding of what an asset actually is. Most people follow the traditional definition, but the wealthy look strictly at the direction of the cash flow. If money is flowing out of your pocket every month, you are not owning an investment, you are managing a liability. The most common weapon used against this logic is the claim that renting is simply throwing money away. This emotional argument ignores the reality that interest, taxes, and maintenance are also unrecoverable costs that provide zero return. When you rent, You are simply paying for the utility of shelter without the crushing weight of long-term debt and depreciation. If you take the difference between a total mortgage payment and a rent payment and invest it into the market, the results are often shocking. Over a 30-year period, the compounding interest of a simple index fund can dwarf the appreciation of a single-family home. You are not just losing money to the bank, you are losing the future version of yourself that could have been truly wealthy. We need to talk about the psychological trap of home equity, which is often nothing more than a paper gain. You cannot use that equity to buy groceries or invest in a new venture without taking on even more debt through a loan. It is a stagnant pool of wealth that sits idle while the rest of the global economy moves forward at a much faster pace. The financial industry has a vested interest in keeping you convinced that your primary residence is your greatest investment. This narrative ensures a steady stream of customers for banks, insurance companies, and real estate agents who profit from your long-term commitment. They earn guaranteed fees from your debt while you bear all the physical risk and the labor of maintaining the collateral. Some argue that inflation helps homeowners by devaluing the debt they owe over time. While this is mathematically true for the loan itself, it ignores the fact that the cost of maintaining that home also inflates rapidly. Your roof, your property taxes, and your insurance premiums all rise with the cost of living, often faster than your wages can keep up. Beyond the financial drain, there is a massive opportunity cost associated with the time spent on homeownership. Every weekend spent mowing the lawn or fixing a plumbing leak is time stolen from building a side business or learning a high-value skill. You are essentially working a second, unpaid job just to keep your liability from losing its market value. The final insult is watching institutional investors enter the housing market and change the rules of the game entirely. These corporations treat housing as a cold, calculated business while the average person is still making life-altering decisions based on outdated emotions. They are betting that you will stay trapped in the cycle of debt while they accumulate the actual productive assets that generate real cash flow. These mega-corporations aren't buying these properties because they believe in the sentimental value of a white picket fence. They are performing a cold-blooded arbitrage, converting your desire for stability into their predictable monthly cash flow. While you are busy worrying about the color of your front door, they are calculating the exact yield they can squeeze out of your neighborhood. The psychological comfort of seeing your home's estimated value rise on a website is one of the most dangerous illusions in modern finance. This paper wealth is completely inaccessible unless you are willing to sell your primary shelter or take on even more debt through a high-interest loan. You are effectively a millionaire on a spreadsheet but a pauper in your daily bank account, trapped by an asset that refuses to pay you back. We have been conditioned to believe that renting is simply throwing money away, yet we ignore the thousands of dollars lost every year to mortgage interest and property taxes. These are unrecoverable costs that provide zero return on investment, much like a rental payment, but with the added burden of maintenance. In reality, renting is a fixed cost for a service, while homeownership is an uncapped liability masquerading as a savings plan. In an era defined by rapid technological shifts and global job markets, the ability to relocate at a moment's notice is a massive competitive advantage. By tethering yourself to a specific zip code for 30 years, you are essentially betting that your local economy will remain relevant forever. The homeownership trap doesn't just take your money, it takes your ability to pivot when the world changes around you. At this point, it seems the conclusion is unavoidable and the traditional American dream has officially become a financial dead end. You might feel a sense of resignation, realizing that the system was designed to keep you running on a treadmill that never actually leads to the finish line. Most people simply accept this fate, settling into a life of quiet desperation while they wait for a retirement that may never be truly comfortable. The weight of this realization is heavy because it suggests that the decades you spent working for your house were actually spent working for the bank's bottom line. You followed every rule, paid every bill on time, and yet you find yourself at the end of the road with nothing but a pile of bricks and a shrinking bank account. It feels like a definitive failure of the strategy we were all told was the only way to win. Society has effectively won this round by convincing an entire generation to trade their most productive years for the illusion of stability. We are left looking at our neighbors, all of us trapped in the same beautiful cages, wondering where the promised prosperity actually went. The game appears to be over, and for the average homeowner, the scoreboard is showing a massive deficit in real, usable wealth. You might be tempted to just stop fighting and embrace the status quo, believing that this is simply the price of living a normal life. Many people reach this stage and decide to stop looking at the numbers altogether because the truth is too painful to acknowledge. They choose the comfort of the myth over the harsh reality of their financial stagnation, effectively closing the book on their dreams of true independence. Even the most optimistic projections now seem like a cruel joke when compared to the reality of inflation and rising living costs. The safety net we thought we were weaving with our mortgage payments has turned out to be a web that keeps us stuck in place. It is a sobering moment of clarity where you realize that doing everything right has led you to a destination you never wanted to reach. Even if you manage to pay off the entire loan, the victory feels hollow as the taxes and insurance continue to climb every single year. You never truly own the land, you just lease it from the government under the threat of seizure if you ever stop paying your dues. The sense of completion is a mirage that disappears the moment the next maintenance bill arrives in your mailbox. It appears there is no escape from this cycle, and the forces aligned against the individual homeowner are simply too powerful to overcome. We are forced to admit that the house didn't make us rich, it simply made us predictable and easy to manage for the institutions that profit from our debt. This feels like the final chapter of a story where the hero realizes they were playing a rigged game from the very beginning. But just as we prepare to walk away from the wreckage of this financial myth, a single overlooked variable changes everything. There is one specific mechanism that the wealthy use to flip this entire equation on its head, turning the trap into a launch pad. We have been looking at the house as a home, but we completely missed the hidden multiplier that changes the math entirely. Even with the knowledge that a hidden multiplier exists, the weight of your current financial situation can feel like an insurmountable wall. You look at your mortgage statement and see a lifetime of labor dedicated to an asset that barely keeps pace with the cost of living. It feels like the game was over before you even placed your first bet, leaving you with the bitter taste of a rigged system. Many people at this stage decide to simply give up and accept their role as a permanent source of interest for the banking machine. They resign themselves to the safety of their four walls, ignoring the opportunity costs that continue to bleed their potential dry every single month. This surrender is exactly what the traditional financial system relies on to maintain its own stability and growth. But walking away in frustration means you are leaving the most powerful tool in the real estate arsenal completely untouched. While the average person is crushed by the weight of their primary residence, the elite are using the exact same tax codes and banking laws to build massive empires. The problem wasn't the real estate itself, but the specific way you were taught to interact with the asset class. The hidden multiplier that changes everything is the transition from being a consumer of housing to a strategic producer of it. When you stop viewing a house as a sanctuary and start viewing it as a tax-advantaged cash flow engine, the math shifts in your favor instantly. This single shift in perspective is the difference between being owned by your home and finally owning a machine that buys your freedom. This shift in perspective reveals the ultimate secret: the wealthy don't buy houses to live in, they buy them to leverage other people's money and the government's tax code. While you were focused on the monthly payment, they were focused on the depreciation write-offs and the principal paydown provided by a tenant. This is the moment where the liability of a home transforms into the velocity of real wealth. The hidden multiplier is the power of positive leverage combined with tax arbitrage. When you buy a primary residence, you are the one paying the interest, the taxes, and the insurance with after-tax dollars. In contrast, an investor uses pre-tax revenue from a tenant to cover those exact same costs, effectively getting the asset for free over time. Furthermore, the government rewards those who provide housing by allowing them to claim depreciation, a phantom loss that offsets their actual income. You are paying taxes on the money you use to fix your roof, while the strategic investor is using that same roof repair to lower their tax bill. This creates a massive gap in net worth that grows wider with every passing year. The homeownership trap only exists because we were taught to play the game as a consumer instead of a capitalist. By treating your primary residence as your main investment, you are essentially betting your entire financial future on a single, illiquid asset. The resolution lies in decoupling your need for shelter from your strategy for wealth accumulation. When you stop pouring every spare cent into a 30-year mortgage, you unlock the capital needed to acquire assets that actually pay you. This is how you break the cycle of quiet desperation and start building a portfolio that generates passive income. The math finally works in your favor because you are no longer the one footing the bill for the bank's profit margins. This is exactly how those institutional investors we discussed earlier are winning the game at your expense. They aren't looking for a place to raise a family, they are looking for a predictable internal rate of return. By mimicking their cold, calculated approach, you can turn the very system that was designed to trap you into a ladder for your own escape. The traditional American dream was a marketing campaign designed to create a stable, debt-bound workforce. True financial freedom is not found in a paid-off house that still drains your bank account through taxes and maintenance. It is found in the ability to choose where you live based on lifestyle, while your assets provide the cash flow to fund that choice. We have finally connected the dots between the emotional myths of the past and the hard financial logic of the future. You now see that the house wasn't the problem, but rather the outdated strategy you were using to manage it. By reclaiming your capital and applying it to productive assets, you move from being a victim of the trap to a master of the machine. This mastery begins the moment you prioritize the velocity of your money over the perceived safety of home equity. While the average person locks their wealth in a vault of wood and nails, the wealthy keep their capital moving through assets that generate immediate returns. This fundamental shift allows you to stop trading your time for a mortgage and start using your money to buy back your life. When you finally stop viewing your primary residence as an investment, you break the emotional chains that the banking system has spent decades forging. You realize that the true cost of a house is not the monthly payment, but the millions of dollars in lost opportunity that never had the chance to compound in the open market. By choosing mobility over a fixed zip code, you gain the leverage to chase the highest returns wherever they appear in the global economy. This is the moment the trap snaps open and you finally step out into the light of a clear financial reality. You no longer need to fear the rising costs of maintenance or the stagnation of local markets because your wealth is no longer tied to a single physical structure. You have successfully decoupled your shelter from your survival, turning a lifelong liability into a strategic choice rather than a mandatory burden. The path to true wealth is paved with the cold logic of cash flow, not the outdated sentimentality of a white picket fence. You now have the tools to rebuild your financial foundation on assets that actually pay you to own them. The homeownership trap only works if you stay blind to the hidden math, but now that you see the numbers, the game is finally yours to win. Winning this game requires a permanent departure from the scripts handed down by previous generations who lived in a different economic reality. The legacy of the white picket fence was built for an era that no longer exists, and clinging to it today is a recipe for financial obsolescence. By choosing to see the world through the lens of cash flow rather than sentiment, you secure a future that is defined by freedom instead of obligation. The consequences of this shift extend far beyond your bank balance, affecting how you spend your most valuable resource, your time. When you are no longer tethered to a 30-year debt obligation, you gain the agility to pivot as the global economy evolves. You stop being a passenger in a system designed to exploit your desire for stability and become the architect of your own economic destiny. Ultimately, the greatest asset you can ever own is not a piece of real estate, but the financial literacy to know the difference between a tool and a trap. Real wealth is the ability to live life on your terms without being forced to subsidize the banking industry's growth at your own expense. You have moved from the shadows of financial myth into the clarity of mathematical truth, and there is no going back to the old way of thinking. But understanding the trap of homeownership is only the first step in a much larger journey toward total sovereignty. While we have dismantled the myth of the primary residence, there is another even more pervasive illusion that is currently draining your potential every single day. To truly master the game of wealth, we must now look at the hidden mechanics of the very currency you are trying to save.